Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back.
Of course. So for today's deep dive, we are looking into something that honestly seems a bit impossible. We're looking at a massive, complicated signal coming from the copper-gold ratio.
Right, the classic mood ring of the market.
Exactly. And, for anyone listening who might be new to this, I like to think of the economy kind of like a car.
Okay, I like where this is going.
Right. So copper is basically the gas pedal. It represents growth, building new things, expanding. And gold, well, gold is the brakes or maybe the seatbelt. It's safety. It's protection for when people are scared.
That's a really great way to put it.
Thanks. And usually if you're pressing the gas, you're letting off the brake. But according to recent analysis in June of 2026, this classic seesaw is doing something completely weird.
It really is. It's totally defying historical norms right now.
Yeah, both of these metals are acting highly unusual. So our mission today is to decode this signal for you, the listener, so you can understand exactly where the market is actually spending its money. Because it's not where you might think.
No, it's definitely not. To understand why things are so weird right now, we kind of have to establish what normal actually looks like first.
Right. So give us the basics. Why do investors usually obsess over copper and gold?
Well, traditionally, copper is the ultimate industrial metal. I mean, it's in our homes, our power grids, our cars.
Pretty much everything that plugs in.
Exactly. So when the ratio of copper to gold goes up, meaning copper is getting more expensive compared to gold, it usually means investors are super optimistic. They're betting on an economic boom.
When it drops, people are hitting the brakes. They're scared.
Right. But the data we're seeing as of early June 2026 is just wild. Copper is hitting record highs. U.S. futures hit 6.6495 per pound recently.
Wow.
Yeah, and over on the London Metal Exchange, prices jumped to $13,840 a ton.
Okay, wait. So if copper is skyrocketing like that, the gas pedal is to the floor, the economy must be in fantastic shape, right? Like, time to celebrate.
You would think so. But no, that's actually a really dangerous assumption right now.
Really? Why is that?
Because the underlying reasons have completely fractured. Back in late 2025, this ratio actually hit a multi-decade low.
Oh, wow. So people were terrified.
Right. But now it's rising. And it's not because of some simple, healthy economic boom. It's because two parallel massive global shifts are crashing into each other.
Okay, break those down for me. What are the two shifts?
On one side, we have this massive technological transition, which is driving copper. And on the other side, we have severe geopolitical fragmentation.
And that's what's driving gold.
Exactly. It's changing all the rules for how nations treat gold.
Okay, let's pull apart the gold side first, the seatbelt. Because it's not acting like a traditional fear asset anymore.
Not at all. Her recent figures from the World Gold Council show that in the first quarter of 2026, demand hit 1,231 tons.
Let me just guess, that's a lot of money.
It's a record-breaking $193 billion.
Good grief. Who is buying all of that? Just everyday investors worried about groceries getting more expensive?
Nope. Central banks alone bought 244 tons of that.
Wait, central banks, why are they hoarding so much gold?
It's all about geopolitical divides. Nations are actively trying to reduce their reliance on the U.S. dollar. They want an asset that sits completely outside the Western financial system.
Ah, I see. So it's not just regular inflation protection. It's sovereign nations building a financial fortress.
Exactly. But here is where it gets really complicated for everyday investors.
Okay, lay it on me.
Gold is becoming hypersensitive to interest rates, not just fear.
Actually, yeah, I noticed a fascinating contradiction in the data about that. On June 3rd, we saw Middle East tensions spike pretty hard.
Right, a classic geopolitical crisis.
Yeah, normally everyone runs to the gold seatbelt, right? But gold actually dropped 1% that day, down to $4,440.99 an ounce.
Which totally confuses a lot of people.
I mean, it's like buying an umbrella, but the wind is blowing so hard it flips inside out. Why did it drop during a literal crisis?
Because gold pays no interest. It just sits in a vault. And during that crisis, oil prices shot up.
Okay, and when oil goes up, inflation fears go up because shipping and manufacturing get more expensive.
Exactly. And when inflation fears rise, the market expects the Federal Reserve to keep interest rates high to fight it.
Which makes the U.S. dollar stronger.
Right. And if you're a big investor, why hold gold for 0% interest when a U.S. Treasury bond might pay you 5% guaranteed.
Ah, gotcha. So the high interest rates are basically kryptonite for gold in the short term.
Exactly. It proves gold is playing by new rules. The central banks are keeping the floor price high, but the daily price is getting tossed around by interest rates and the dollar.
Okay, so that's the gold half of the ratio. The seatbelt is strapped tight by global politics. But if gold is that high, why is the ratio still going up?
Because copper's demand is shifting into absolute overdrive.
Right, the technological transition you mentioned earlier, the physical cost of the AI revolution.
Yes. People talk about AI as, the cloud or software, like it's invisible.
Like it just lives in the air somewhere.
Right, but the cloud lives in massive, concrete data centers.
Yeah.
And those data centers are incredibly power hungry. We are entering a power infrastructure supercycle.
So everyone is focusing on buying the fastest race cars, like the new AI chips from NVIDIA and others.
Exactly.
But copper is the actual asphalt for the highway. You can't race without the roads.
That is the perfect analogy. AI needs massive amounts of power. Power needs transformers and grid upgrades, and all that requires thousands of miles of copper wiring.
Just how much copper are we talking about here?
Well, according to data from S&P Global, AI and defense growth could push global copper demand from 28 million tons in 2025 up to 42 million tons by 2040.
Wait, 42 million, that's a massive jump. Can we even mine that much that fast?
Probably not. The data suggests we could face a 10 million ton shortage.
10 million tons short, that's insane.
It is. The capital rushing in to fix this is staggering. Global power grid investments in 2025 alone topped $400 billion.
So AI is literally eating the world's copper supply.
Yes, but, and this is a huge but, we have to look at the American market specifically right now, because not all of this recent price action is just AI.
Oh, there's something else going on.
Yeah, there is a massive short-term disruption happening that investors desperately need to know about.
Okay, what kind of disruption?
In late May 2026, the market entered what analysts are calling tariff roulette.
Tariff roulette. Okay, explain that for our listener.
Right now, the Trump administration is conducting a Section 232 investigation into copper imports.
Okay, and for the beginners out there, a Section 232 basically means they're looking at whether importing this stuff is a national security risk, right?
Exactly. Because copper is so vital for power grids and defense, the administration is considering heavy tariffs. The decision is expected by late June.
What kind of numbers are being thrown around?
There is serious talk of a 15% tariff on refined copper imports starting in 2027, and then bumping up to 30% in 2028.
30%. That's a massive tax increase for any company building these data centers or electrical grids.
Right. So how do you think those companies are reacting right now?
Oh, I see. They're panicking. It's like stocking up on canned goods before a storm hits.
Exactly. They are hoarding copper. U.S. warehouse inventories have spiked over 550% since early 2025.
550%. Wow. So the price of copper right now isn't entirely real demand from AI?
No, a massive chunk of it is just companies buying up everything they can before the taxes go up.
Okay, so I want to warn the listener right here. Do not mistake a pre-tariff hoarding frenzy for pure AI growth. The underlying consumption hasn't changed that wildly yet. People are just terrified of the impending supply cutoff.
Exactly. If you misinterpret that, you could get really burned.
Which brings us to the real-world application. With both the AI hype and this tariff roulette inflating copper, how does a beginner actually use this information?
Well, first, you have to watch out for oversimplification. There's a great industry term popping up in the data right now. Braggawatts.
Braggawatts, like bragging about megawatts.
Exactly. Tech companies are bragging to their shareholders about these massive gigawatt-scale data centers they're going to build.
Painting this picture of infinite rapid growth.
Right. But building these facilities is severely delayed. You have permitting issues, local zoning fights, union labor shortages.
Oh, right. You can't just drop a facility that uses as much power as a mid-sized city into a random suburb without someone complaining.
Exactly. It can take 5 to 7 years just to get the permits for the high-voltage lines. Plus, there are equipment shortages. You can't even get a commercial power transformer right now without waiting 2 years.
Wow. And is copper the only option? Like, if I'm a utility company and copper is $20,000 a ton, wouldn't I just use something else?
You hit the nail on the head. That's the substitution risk. Copper might actually get replaced by aluminum for the overhead transmission lines.
Because it's cheaper.
Right. It's less conductive, so you need thicker cables. But if copper gets too expensive, they'll pivot. And inside the data centers, they're already trying to replace copper with fiber optics to save money and reduce heat.
Okay, so if the copper to gold ratio is going up, should our listener just, buy the S&P 500 or maybe go all in on a bunch of copper mine stocks?
I would strongly advise against going all in on just the miners.
Why is that? If copper is at record highs, shouldn't the people digging it up be printing money?
You would think so, but the 2026 market is very divided. Mining is incredibly expensive. As inflation hits their diesel fuel, heavy machinery, and labor, the cost to mine that copper goes up too.
Plus, I'm guessing there's a lot of regulation and geopolitical risk if the mine is in another country.
Huge risks. A sudden tax change or environmental rule in a foreign country can wipe out a mining company's profit overnight.
So don't just blindly buy the miners. What's the better strategy for our listener?
Look at where the real bottleneck is. It's the physical infrastructure.
The picks and shovels of the gold rush.
Exactly. Instead of betting on the raw metal, look at the companies building the actual components, the ones making the commercial transformers.
The cooling systems for those hot AI chips?
Yes, the grid upgrades, the power management software, these companies are going to have guaranteed demand for the next decade, regardless of what the copper tariff roulette does tomorrow.
Because even if an AI data center gets delayed, some local city still desperately needs to upgrade its 1970s power grid.
Precisely. The structural demand is locked in.
Okay, this has been an incredible breakdown. So to summarize for the listener, the rising copper to gold ratio today isn't just a simple buy stocks green light like it used to be.
No, it's much more complex now.
It's basically a flashing sign that the digital world AI, the cloud, is violently crashing into the physical world. Infrastructure, power, heavy metals, and all of this is happening while global politics and the Trump administration's tariff investigations are totally scrambling the supply chains.
That's a perfect summary. And, I want to leave the listener with one final kind of provocative thought to mull over.
Oh, I love these. Let's hear it.
We have spent the last 20 years assuming that the most powerful tech companies in the world would be the ones with the smartest software engineers and the best code.
Right, the Silicon Valley model.
Exactly. But if the real bottleneck for the AI revolution is copper, commercial transformers, and local grid permits,
Oh, man, I see where you're going.
will the next true tech superpowers actually be the companies, or even the countries, that control the physical earth and the raw metals?
Wow. That completely flips the script. Are the rulers of the AI age going to be coders or the people who own the dirt and the wires?
That is a fascinating reality to consider as you all look at your portfolios this year.
It really changes how you look at the market.
It absolutely does. Thank you so much for joining us to unpack these incredibly complex market signals today.
My pleasure.
Don't forget to subscribe and hit that like button.